Imagine combining the benefits of real estate with the potential for tax-free growth. Thousands of Entrust clients have done exactly that by investing in real estate using their Roth IRA. Hi, it's Ben Tushman with the Entrust Group. In this video, we'll explore the benefits of this investment strategy and some potential drawbacks that you should consider. Let's get into it. While traditional IRAs offer the potential for tax-deductible contributions and tax-deferred earnings, Roth IRAs provide tax-free growth and withdrawals during retirement. And if you anticipate being in a higher tax bracket in the future, investing through a Roth IRA could lead to greater overall tax savings than a traditional IRA. Now, many investors believe these accounts can only hold stocks, bonds, and mutual funds. In fact, Roth IRAs can invest in any asset the IRS allows, including residential and commercial real estate. All you need is a self-directed Roth IRA or Roth SDIRA. This type of investment account empowers you to channel your retirement funds into alternative assets of your choosing, like real estate. This approach combines real estate's potential for substantial cash flow and capital appreciation with the tax-free growth of a Roth IRA. With a self-directed Roth IRA, you have plenty of options to expand your real estate portfolio. Think residential properties like single-family homes, apartments, or condos that you can rent out for steady cash flow. Commercial real estate like office buildings, retail space, or warehouses, undeveloped land, and real estate investment trusts or REITs. Though not direct real estate investment, REITs are companies that own or finance income-producing real estate. Investing in a REIT through a self-directed Roth IRA allows for a little bit more liquidity than direct property ownership. And finally, real estate notes and mortgages. Again, this one isn't direct property ownership, but you're investing in the financing side of real estate by holding mortgages or notes. This way, your SDIRA acts as the lender, earning interest on the loan secured by real estate. Many investors choose to invest in a real estate market in which they have unique expertise. For example, if you know your local real estate market like the back of your hand, you may be able to achieve greater returns than what's available with a target date retirement fund. To make the most of real estate held in a Roth SDIRA, it's crucial that you follow the IRS rules closely. Here's what you need to know. Avoid disqualified persons. Certain transactions within an IRA are off limits, including using the property for your own personal benefit or dealing with disqualified persons. This includes, but is not limited to, your spouse, direct descendants, or even yourself. Maintain an arm's length relationship. Keep clear separation between your IRA-owned investment property and yourself to ensure compliance. For example, using your personal time and energy to paint the walls of an investment property held in your Roth IRA would violate the arm's length relationship. And pay expenses properly. All property expenses must be covered by the Roth IRA. Similarly, any income generated by the property must funnel back into the IRA. By understanding and adhering to these regulations, you can maximize the benefits of investment properties held in your Roth IRA. Investing in real estate with your Roth SDIRA can offer significant benefits. We've already covered tax-free growth, but there's also portfolio diversification, which can help safeguard against market volatility. If you have unique expertise with real estate or in a specific market, you can actually leverage that expertise to potentially boost your returns. And if an investment property is outside of your Roth IRA's budget, you can actually expand your purchasing power using a non-recourse loan or partnering with another pool of funds. Of course, every investment strategy has its trade-offs, and investing in real estate through a Roth IRA is no exception. The first thing to be aware of is that real estate is, and as far as I know, always will be, less liquid than stocks and bonds. So if you know you're going to need access to your retirement funds sometime in the near future, this might not be the strategy for you. Another thing to be aware of is that real estate does require property management. As we touched on previously, all property expenses must be paid through the Roth IRA in order to maintain the account's tax advantages. And finally, one other crucial thing to be aware of is unrelated debt finance income, or UDFI. Now, UDFI only applies to investment properties financed using a non-recourse loan in an IRA. If you financed an IRA-held investment property, the income generated by the financed portion of that property is subject to unrelated business income tax. This can reach as high as 37% in the highest tax bracket. So definitely, before taking out a non-recourse loan, be sure you are aware of that. It's essential to weigh these factors before expanding your real estate portfolio with a Roth IRA, and also important to state this investment strategy isn't for everyone. Navigating the complexities of real estate investing held in a Roth IRA requires a thorough understanding of the IRS rules and regulations. And if you're not willing to conduct detailed due diligence, then you may want to steer clear of this investment strategy. That said, if you're an experienced investor seeking portfolio diversification and you're comfortable with a heightened risk profile, a Roth SDIRA might be right up your alley. For more information, check out our Roth IRA real estate investing blog post. In that article, you'll find real estate due diligence strategies and a 5-step process to get started. We'll link that in the description. Otherwise, let us know if you have any questions. And if you want more real estate SDIRA content, give us a follow on whatever platform you're watching this on. We'll see you next time.